Hello and welcome to the Larson Financial Market Minute for July 22nd, 2014. I'm Craig Larson. Thanks for tuning in, and I hope you're enjoying your summer so far. So the update on markets is that there haven't been any major shifts. As far as the broad asset category rankings, we still have U.S. stocks in first place on a relative strength scale, international second, then bonds, foreign currencies, cash, and commodities still dead last. Now, commodities have been 6th out of 6th place for well over 2 whole years. However, with the strength in gold and oil this year, they've come in within 1 point of cash or money market rankings. So, things are starting to wake up a little bit there, maybe look a little bit more appetizing. So we'll continue to watch that to see if they can get out of last place. Now with the U.S. stock market, we're seeing some rotation where the strength over 2012 and 13 was in the micro cap and small company aggressive growth type funds or area, and now the strength has kind of moved into the S&P 500 blue chip blend and value type area. So some analysts are saying, hey, that's a sign of a top. And as we have mentioned over the last couple of videos, valuations on the U.S. stock market are the 3rd highest in history. So that's that question has merit. So I went back and I looked at one time in 1998 where valuations had gotten to very extreme levels. We saw a rotation out of the very aggressive funds into the S&P 500 index type funds having more strength. But in that case, the U.S. stock market continued to vault higher for 2 whole more years before it finally peaked in the year 2000. And of course, you remember what happened after that. We had the tech wreck, the bubble burst. It was a negative market from 2000 through 2002. So I think on this valuation issue, we can say, there's high potential risk, but since the trend still appears very strong in U.S. stocks, there's no telling how much farther that has to go. But given the potential risk, you want to make sure as an investor that you've got a risk management strategy or an exit strategy, because when this thing finally rolls over from this level of valuations with record high margin debt on the exchange, things could get very dicey very quickly. Secondly, with international stocks, whereas over the last couple of years the strength has been in the developed markets, primarily Europe, and emerging markets has lagged, we're starting to see some emerging markets perk up. India, notably, has been a fantastic performer in 2014, has a lot of relative strength now built up in that, and also Brazil. So Brazil's kind of been in the doldrums stock-wise for the last 3 years, and although they didn't get their World Cup title this year, maybe they can start making money in their stock market again, because it looks like it's trying to break out. So those will be some fun categories to watch, especially for you aggressive investors out there. Finally, with interest rates, many analysts were calling for rising rates in 2014. Hasn't happened yet. Rates have been falling on the 10, 20, and 30-year government bond yields. And in fact, even right now, I just checked the charts this morning, the daily and weekly momentums on interest rates are still down, which gives bonds a nice tailwind. So when is that going to shift? Well, we don't know. But as long as those momentum lines are down, I think it's safe to assume that rates are likely to continue to go down a little bit. So we'll keep an eye on that for you as well. So if you're a client of ours already, we've probably already been through all of this with you in a portfolio review, pinning down your risk management strategy and exit strategies and so forth. If you're not a client and you're not sure what your strategy is, now would be a great time to reach out and give us a call or email me, and we'd be glad to set up a time for a portfolio review and stress test. So in the meantime, enjoy the rest of your summer, and I'll be back within 2 or 3 weeks here with another video. Have a great day.